Hi everyone. Let's take a look at problem 5-6 where we're asked to prepare a statement of cash flow and a balance sheet. Okay, we've got the All-Star Cookie Company in front of us and we have a balance sheet for December 31st, 2006 in front of us as well. And then we have 8 facts that occurred during 2007. So they sold part of its investment portfolio, resulting in a gain. The company sells securities as a regular part of what they do. A tract of land was purchased. Long-term notes payable were retired. Additional capital stock was issued at par. Dividends were declared and paid. They also tell us the net income in number 6, and they tell us the amount of depreciation, $12,000. They tell us that land was purchased through the issuance of bonds. And at December 31st, they give us the cash balance, the AR balance, and accounts payable, which looks like AP remain the same. Okay, so to prepare a statement of cash flow, we've got a little information to get us started. Now, normally net income is the first thing that's calculated, and they tell us that net income for 2007 was 32, I'm going to say thousand. Was this in thousands? No, this is actually in whole dollars. Okay. And after we have net income, the first thing we have to do is add back, and I'm going to abbreviate here, add back adjustments to reconcile net income to net cash provided by operating, provided by operations. Okay, that might say operating activities. I've heard that called a couple things periodically. Okay, we'll slide up a little bit. Okay, so some of the adjustments, normally the first one is depreciation. They tell us right there it's $12,000. So we'll just type in depreciation expense and reference that $12,000. The next item is they tell us there was a gain on the sale of securities, right? Yeah, there's our gain. So why don't we type in gain on sale of investments. And they regularly do that, so it's part of operations. And that gain is $3,400. So now, because that's a gain, that's a non-cash gain included in income, so we need to subtract that out. So we'll enter that as a negative amount. And then if we look at the other items, we have to go through the working capital, and what we noticed was AP didn't change. Cash we deal with at the end. The only other item in working capital is accounts receivable. So it was $21,200 at the beginning of the year, and what do they tell us at the end of the year? $21,200 accounts receivable. It ends at $41,600. So we've got to compute that increase. So if we've had an increase in accounts receivable, an increase in accounts receivable means there's a greater investment in it, or accounts receivable grew. So if holding everything else the same, that means we used more cash to fund that increase in accounts receivable. So we'll take that beginning AR balance, 21.2, and subtract out that ending AR balance of 41.6. Okay, now I did that off the screen, so let me show you. It's cell D14 minus H31, and that's a decrease in cash of $20,400. And really, now that we've covered the non-cash items on the income statement and all the non-cash items in working capital, we've accounted for all the items that need to go in our schedule of adjustments to reconcile net income to net cash. And it doesn't like how it's going to do this. Okay, so I'm just going to sum this by just using the plus key to deal with the formatting that was in this template that we use. Okay, so we had a net adjustment 11.8, and if we add the $32 million of net income plus the adjustments to reconcile net income to net cash, we come up with $20,200 net cash provided by operating activities. Okay, then the next thing we need to look at is cash flow from investing activities. And this means we're looking at changes in long-term assets and other assets. I believe they told us there was a sale of investment. There it is. Sold part of its investment portfolio for $17,000. Okay, and it resulted in the gain of the $3,400. So we already have accounted for that adjustment, but they tell us the sale and proceeds, that's what that means, is $17,000. So I'm going to fill that in as a sale of investments. And then the next item, it's already filled in for us, was the purchase of the land of $18,000. Tract of land was purchased for $18,000 cash. So that is purchase of land, $18,000, and the formula already dropped in for us. Just sums the two. So we had a $1,000 net outflow from cash flow from used in investing activities. Okay. Let's slide a little bit down. Okay, then we have cash flow from financing activities. So here we've got to calculate all the net changes that we saw in long-term liabilities and stockholders' equity other than the change caused by net income. Okay, so when we think about that, the first item they told us was there was an issuance of capital stock. Right there, an addition of 24 capital stock was issued at par. So I'm going to call that an issuance of capital stock. And that's $24,000. Okay. And by the way, when you do this on your own, you may want to highlight which ones you've tackled. Like you could gray that one out, and then you've dealt with it. And so by the time you're done, you'll know that you've accounted for every single item. Okay? That's something to keep in mind. Now, I'll take that off since I didn't start off doing it that way. I'll complete the problem without doing it that way. But that's one way to make sure you've considered every fact and which ones are relevant and which ones just may be extraneous that can be ignored. Okay, we issued of capital stock $24 million. Dividends of $8.2 were declared, but I think there may even be a larger one. Wasn't there a retirement of notes? Yeah, long-term notes payable, $16,000. So that's our next largest one. So I'm going to type that in as retirement of notes payable. And that's, I'm going to equals, it's a retirement, which means we had to pay cash to get rid of that. So I'll subtract that $16 million, slide back down, and then that last item was the payment of the cash dividends. And I think that's everything in cash flow financing. Dividends were declared and paid, so that's also an outflow of $8,200. Okay, so if we sum all that, this time I will use the sum key. We had a net outflow of $200. Okay, so from there we can calculate the net increase in cash by adding up the three sections of the statement of cash flows. The net cash provided by operating, plus net cash used in investing, and what was used by financing. Now remember, whether this will say used or provided depends on whether this number is positive. If it's positive, we say provided. If it comes out negative, you need to say used. Okay, and then they tell us cash at the beginning of the year. I think it was $20,000. Right there is our ending of year. Where do they tell us the beginning of year cash? We're doing 2007. Since this is the ending 2006, that is our beginning of the year. So that's in cell D13. So we'll reference equal cell D13. And if we've done everything right, this should prove our cash balance, $39,000. And I'm not sure they tell us. Yep, look at that. They tell us right there that that's in cell E31. I'll hit the F2. Right to the left of my mouse. It was $39,000. And that's one way we know that we did the statement of cash flows the correct way. Okay, then